Nobody ever said that budgeting is their favorite part of business management. Most people would rank it as one of their least favorite things. And yet, so many of us spend countless hours budgeting. Budgeting is hard. It doesn't bring out the best in people. Everyone is stressed. It's sometimes not very effective. Still, we think the pain is worth the gain. We cling to time worn practices, thinking it's the best we can do. It's easy to use a similar budget process year after year. I hope this course lets you look at your budgeting process with fresh eyes to see new ways to budget and make business decisions. I hope this course helps you better understand and achieve what you hope to gain from the massive investment your company makes in the budgeting process. In this course, I'll focus on the master budget and the budgets that comprise it. There's a method to the madness when different types of assumptions and calculations are layered into the budget. However, the process is not entirely sequential. It abounds with iterative loops. I used puzzle pieces for the side graphics for the course slides because putting together a budget is like fitting the pieces of a puzzle together to form a picture of your company's future. Every company is unique, so I may not cover the exact products, departments, and items that apply to your industry. I will cover the basics of a manufacturing company and a service company to provide examples applicable to most companies. This course is part of a three-part series I call Better Budgeting. The three parts are this course on the master budget and sub-budgets, the budgeting process, and budgeting alternatives. I originally submitted the series as a single 10-credit course titled Better Budgeting. While I can talk for hours on budgeting, the course site said that people prefer video courses that are 2 to 3 hours or less. If that's true for most courses, I bet it's especially true for something as scintillating as budgeting. So, by popular demand, I broke the course into three different pieces. I may make a brief reference to topics I cover in other parts, but don't worry, the three courses were the three main sections of the original course and do very well as standalone courses. Of course, feel free to grab a big bowl of popcorn and binge watch the whole series. Do companies fail from poor technical budgeting? No, they fail from poor strategy and execution. The budget is the most thoroughly analyzed financial forecast of strategy. For some companies, it's the only financial analysis of strategy. To be effective, we must mitigate the decision-making errors common to the budgeting process and look for ways to better identify opportunities. The effectiveness of a budget isn't the precision of our forecasts, but the quality of the decisions made in it. The goal of budgeting is to make good decisions. It is then a reliable map for good implementation. Everything in this course is focused on helping you make better decisions through traditional budgeting or alternative processes. I'm Rob Stevens, founder of CFO Perspective. CFO Perspective provides tools and knowledge to make better financial decisions that lead to superior business performance. During my career, I've been the CFO, Senior Vice President of Finance, or Director of Operations of companies with just a few employees to companies with $3 billion in assets and hundreds of employees. I've been part of many budgeting processes, and I've got the scars to prove it. I make courses for company employees as well as for business advisors like CPAs, coaches, and consultants. When I say you, I'm referring to business owners or staff. If you are a business advisor, you can translate you to mean your clients or the business you work for. The titles for the teams or people that put together a budget are different for each company. I refer to the accounting, finance, or FP&A, financial planning and analysis function or department that usually do this as finance in this course just for simplicity. With that intro and admin out of the way, let's get this budget party started. Modeling revenues and costs. A company is a group of people scurrying around doing things that cause revenues and costs. Accountants use models to summarize and analyze this. As George Bach said, all models are wrong, but some are useful. Financial statements, accrual accounting, and cost volume profit analysis are all models, not the actual activity itself. However, all of these can help us build a budget that will drive the activities for the year. The first budgeting question may seem painfully obvious. What financial statements should you budget?
The obvious answer is the income statement, also known as the profit and loss or P&L statement. This is correct, but it probably is not the best place to start or end your budgeting. Significant revenues and costs are driven by a mix of counts and dollars. Sales revenue is the product of the number of units sold and the price per unit. Cost of goods is the product of the number of units sold and the cost per unit. Additions to inventory derive from production costs and quantity. Staffing costs are the total of the time each employee works multiplied by their wage rate or salary. You could just budget a dollar amount for sales revenue, cost of sales, or employee costs. This doesn't get into the key assumptions behind these amounts. It doesn't isolate the drivers of the revenues or expenses. I'll show later why you want to isolate these for sensitivity testing and scenario planning. They are also likely important for key performance indicators, KPIs, compensation, production planning, or staff planning. You'll likely also want a cash flow projection. For small companies, you may not project an at accrual based income statement and just budget cash flows. A cash flow projection can help you plan distributions to owners, identify how large of a line of credit you may need, schedule large fixed asset purchases and related funding, determine if your cash from operations will be enough to fund the company or whether you'll need capital infusions. Calculate the burn rate and runway for startups. Estimate your sustainable growth rate. Companies without accounts receivable or accounts payable may think a cash flow forecast is unnecessary. Their income statement closely approximates cash from operations. They still need to project financing and investing cash flows. Loans and cash flows to or from owners are very important parts of planning. Companies with AR or AP have two very important assumptions they would want to model and manage: average days to collect receivables, and average days to pay payables. Once again, the key driver of a dollar amount is a non dollar amount. For both AR and AP, it's the number of days. These are amounts you may want to sensitivity test. The number of days taken to collect receivables, or the related metric of the amount of past due receivables, may be a KPI for your company. If cash is critical to the operation of your company, and when is it not? And if that cash is strongly influenced by accounts receivable, accounts payable, inventory, and fixed asset purchases, then you may want to budget a balance sheet. This helps you not miss major cash flows. It acts like a check and reconciliation of your budgeted income statement and cash flow projection. Your balance sheet may also be a major driver of revenues and expenses. This is true for banking and insurance companies. It's true for any company that has assets that produce significant rents, interest, dividends, or gains and losses. To summarize, should your budget include a cash flow projection? Definitely. Income statement? Probably. Balance sheet? Maybe. Every business has its own set of supporting analyses for budgeting line items for these reports. Thinking of budgeting as an accounting exercise can lead to two mistakes. Budgets look similar to income statements, but the process is very different. It's a financial planning and modeling exercise, not a detailed reporting exercise. Present the analysis in whatever form helps make good decisions, even if it doesn't look like an income statement or any other GAAP financial report. Accountants spend whatever time is necessary to produce highly accurate reports of a knowable past. Financial analysts spend only the time needed to make good decisions about an uncertain future. In the crush of budget season, stop at the point where diminishing returns from more analysis exceed the cost. Polishing the crystal ball won't make the future any clearer. Finance must budget their time carefully when building the financial budget for a company. I said earlier that revenues and costs are driven by a mix of counts and dollars. Let's look at how a business financially fits together from another perspective. Most businesses could be summarized as variable revenue minus variable expenses minus fixed expenses equals profit before taxes. This is called the cost volume profit or CVP analysis. It can be further broken down into this formula: the number of units sold times price minus the number of units sold times expense minus fixed costs equals profit. This CVP formula is based on accrual profit, so it multiplies the variable expense per unit by units sold. Accrual accounting tries to match expenses to related revenues. It's a useful and worthy exercise, but confuses non accounting people. You pay your bills with cash, not profit. Many small businesses budget only on a cash basis. If you want to run a CVP on a cash basis, Use units produced instead of units sold when calculating variable costs. The formula doesn't include fixed revenue. Fixed revenue is the passive income that many infomercial gurus tout. In reality, fixed revenue tends to come from two major types of investments, followed by a stream of income. Investment of time. Examples include royalties, course sales, and book sales. Investment of money. Examples include investment income and rental income. Notice the second bullet is the balance sheet driven cash flow I mentioned earlier. The first bullet isn't reflected on the balance sheet unless the labor gets capitalized. This image shows a cost volume profit graph. Fixed costs are $10,000. Each unit brings in $500 of revenue and costs $100, so each unit contributes $400 towards offsetting the fixed costs. At 25 units, the contribution from selling units equals fixed costs, so profit equals zero. This is the break even point. You may be tempted to think that CVP formula is the same as a simplified income statement, which is sales minus cost of goods minus other expenses equals profit before taxes, but it's not. The income statement is grouped by production costs and non-production costs. CVP analysis groups costs by whether they vary with production or don't. Production overhead is applied to the cost of goods in the income statement but goes into fixed expenses for CVP analysis. Advertising expenses, especially search engine advertising, may be an expense that varies with revenue, go into other expenses in an income statement. The most important categorization of expenses for modeling is variable, step fixed, or fixed. For many financial reports, it's direct, indirect, or overhead.